The VIX hit 82 in March 2020, and 3 days later the stock market bottomed and started climbing. Not after the VIX fell, while it was still near its peak. If the VIX is supposed to measure fear, why does the panic signal fire right before the recovery, not at the deepest point of the collapse? The answer changes how you read every market crisis. Most people assume the VIX is some kind of market seismograph. It wiggles when the ground shakes. That's wrong. Realized volatility does exactly that. It calculates the actual daily price moves the S&P 500 made over the past month and gives you a historical reading. The VIX does something completely different. It measures what investors are paying right now for options, insurance contracts, on future S&P 500 moves over the next 30 days. One looks backward at what happened. The other reads a live price tag on fear of what might happen. They are two separate instruments measuring two separate things. Here's what makes that distinction concrete. In mid-2017, the S&P 500 had barely moved for weeks. Realized volatility, the actual trailing price swings, was around 6%, one of the lowest readings on record. But the VIX sat near 10. Why wasn't it at 6 too? Because realized vol tells you what the market did. The VIX tells you what options buyers are paying to be protected against. Even in the calmest periods, investors still pay a small premium to hedge. The price of that insurance never hits zero. Two calm readings, yes, but 10 versus 6 are two separate meters, pointed in two separate directions. So if the VIX isn't measuring past moves, what exactly is it calculating? The CBOE takes a wide strip of S&P 500 put and call options spanning many different strike prices, and weights their midpoint prices to extract a single number. The result is then annualized. Think of it this way. If the collective price of all those options implies the market is pricing in a 1% daily standard deviation in S&P moves, you annualize that by multiplying by the square root of 252 trading days. 1% times roughly 15.87 gives you about 15.9%. So the VIX prints near 16, which means the market is pricing in approximately plus or minus 16% annual swings. The number isn't a poll or a survey. It's extracted directly from what options actually cost in the market right now. Now that we know the VIX is an annualized number, we have to scale it correctly to understand what it's actually predicting for any given window. The formula is simple. Expected move over n trading days equals VIX divided by 100 times the square root of n over 252. For a single month, that's VIX divided by the square root of 12. For a single day, VIX divided by the square root of 252. Take a VIX of 20. The implied daily move is 20 divided by 15.87, about 1.26%. The implied 30-day move is 20 divided by 3.46, about 5.8%. That's the market's best collective estimate of a one standard deviation range for the coming month, not a forecast of direction. Just the expected magnitude of the move in either direction. So now we know what the VIX measures and how to read its scale, but that still leaves the big puzzle from the opening. Why does the VIX spike before or right at the start of a crash, not at its worst moment? The mechanism is a causal chain. Uncertainty rises, maybe a bank collapses, a virus spreads, or a policy shock hits. Investors rush to buy put options as protection before the worst arrives. That surge in put demand inflates option premiums. Inflated premiums push the VIX higher, and then the underlying market sells off as more sellers pile in. By the time the crash reaches its trough and the direction becomes clear, even if prices are still devastatingly low, uncertainty actually begins to fall. The fear premium gets priced in early, not late. March 2020 is the clearest example in modern market history. The VIX hit 82.69 on March 16th. 3 days later, on March 18th through 23rd, the S&P 500 hit its pandemic low and began its recovery. Anyone watching the VIX and waiting for it to calm down before stepping back in, waiting for it to drop back to 20, say, had already missed the entry by weeks. The VIX was still screaming above 40 as prices were already rising. The signal fired at the onset of peak uncertainty, not at the moment of maximum price damage. The crash bottom came while the VIX was still near its own peak. But there's a mechanical reason the VIX and the S&P 500 are almost always moving in opposite directions. It's not just sentiment. When stock prices fall, equity holders become more leveraged because the value of their assets drops while their debt stays fixed. That rising leverage increases default risk, which pushes investors to buy more put options for protection. More put buying means higher option premiums, which means a higher VIX, automatically, almost regardless of how anyone feels. Historically, the correlation between daily VIX moves and daily S&P 500 moves is around negative 0.75. A deeply persistent inverse relationship baked into the structure of leverage itself. And this relationship is asymmetric. Fear moves faster than greed. On days when the S&P 500 drops 1%, the VIX tends to rise roughly 4 to 5 points. On days the S&P rises 1%, the VIX tends to fall only about 2 to 3 points. The market buys protection faster than it sells it back. That asymmetry means VIX spikes are sharp and fast. They can double or triple in days, but VIX declines are gradual, grinding lower over weeks or months. A mirror that breaks quickly but reassembles slowly. This asymmetry is why VIX crashes are rarer than VIX spikes, and why the instrument feels dramatic every time it moves. Given that extreme VIX readings happen in clusters around crises, a reasonable question is, do they last? The answer is no, and this is one of the most statistically reliable facts about the VIX. It mean reverts, consistently. Its long-run average is around 19, and extreme readings, high or low, tend to pull back toward that center. The mean reversion half-life is roughly 20 to 25 trading days, meaning a spike gets about halfway back to normal within a month. Readings above 30 have historically resolved back toward the 15 to 20 range within about 3 months in the majority of historical instances. The extreme is always a temporary condition, not a new state of the world. The 2008 crisis traces that arc perfectly. The VIX peaked at 80 in October 2008, a once-in-a-generation reading. By January 2010, roughly 15 months later, it had returned to the low 20s. By mid-2013, it was back below 15, completing a textbook mean reversion that took about 5 years to fully trace out. But here's what makes mean reversion cut both ways. It also applies at the bottom of the range. When the VIX drops below about 12, the complacency zone, that's historically been a reliable early warning that elevated volatility is coming within the next 6 to 12 months. Calm isn't permanent either. Now for the most important boundary of the whole VIX framework, the one most people collapse when they first start using it. The VIX tells you magnitude. It does not tell you direction. Implied volatility is an unsigned number. A VIX of 40 means the market is pricing in roughly plus or minus 25% annual moves. The plus or minus is real. Both directions are priced in equally. After VIX spikes above 40, the historical 30-day S&P 500 returns average around positive 4%, but with a standard deviation of about 15%. That means the distribution of outcomes is enormous. The market could be up 20% or down 10%, and the VIX reading alone gives you no information about which. October 13, 2008. The VIX was still above 60. The financial system was, by any reasonable measure, in free fall, and the S&P 500 rose 11.6% that single day, one of the 10 best single-session gains in the index's entire history. High fear and extreme upside coexisted perfectly because the VIX never told anyone which way the market would go. It only said the move would be large, and it was just in the direction most people holding high VIX as a bearish signal didn't expect. The VIX is a measure of expected magnitude, period. Treating it as a directional signal is a category error with real consequences. So let's pull the whole picture together. The VIX is not a seismograph of past shaking. It's a live price signal extracted from options markets, measuring the collective cost of insuring against large S&P 500 moves over the next 30 days. It's annualized. Scale it by the square root of your time window to get the implied move for any period. It has a strong negative correlation with the S&P 500 of around minus 0.75, meaning it moves inversely with prices by structure, not just sentiment. It spikes before or at the onset of crashes because fear gets priced in early. The demand for protection surges before the maximum price damage lands, and it mean reverts reliably back toward its long-run average near 19, making both extreme spikes and extreme lows statistically temporary. The one thing it never tells you, which way the market is heading.